Hi, welcome to Module 11c, and continuing on with present values, we're going to discuss debt restructure, which is, always a sad thing when people cannot pay their bills, okay? So we're going to begin with page 382, and you're also going to need your financial accounting and reporting handout. I've done all this. They presented in a module. I do it in a 2.5-page handout beginning on page 9. We do pages 9, 10, and half of page 11 for Module 11c. Before I go on and do that, I wanted to point out to you what are the multiple choice questions that you should do for this. For Module 11c, present value debt restructure, I want you to do multiple choice questions number 1, 2, 3, and 5. Okay, we're going to be looking at our handout, which is on pages 9, 10, 11 of the Financial Accounting Reporting handout. There is no simulation assigned for this. Also, there's 4 keywords that I wanted to point out to you. The 4 keywords that I want to point out to you are on page 386. So please turn to page 386. On the left-hand column, I want you to check off impaired loan. In the middle of the column, it's impairment of loan and modification of terms. And in the right-hand column, troubled debt restructuring. So the 4 keywords are impaired loan, impairment of a loan, modification of terms, and troubled debt restructuring. What's the likelihood of something like this showing up on the exam? Unlike what we just did, which is Module 11b, which is bonds, which you can always expect multiple choice, and maybe you might expect a simulation where you might do a amortization schedule. Predominantly with Module 11c, with debt restructure, I really only see like maybe 1 or 2 multiple choice questions on it. I mean, in the entire module, there is only 8 multiple choice questions. They do have a simulation, but I really doubt that they would ask a simulation on something like this, only because there's so many other things they could ask simulations on besides troubled debt and debt restructure. All right. Why don't you turn, please, to page 382. The same time we eyeball page 382, we're also going to eyeball page 9 of your Financial Accounting and Reporting handout. At the top of page 382, it says letter C, debt restructure. SFAS number 15 prescribes accounting for debtors in situations where creditors are compelled to grant relief, that is, to restructure their debt. 2 types of restructure are described. The first type of restructure is a settlement of the debt at less than the carrying amount, and the second time is a continuation of the debt with a modification of terms. So standard number 15 is predominantly the accounting for the debtors. Then we have standard number 114, as it was amended by standard number 118, addresses the accounting for the creditors for impairment of certain loans. Impaired loans include all loans that are restructured in a troubled debt restructuring involving a modification of terms. As in other types of financial assets and financial liabilities, when we have a troubled debt, which is typically like a notes receivable, and when your debtor is having a problem paying you on your notes receivable is considered to be a financial asset. Now, because it is a financial asset, it may be subject to the requirements under standard number 159, which is a fair value option. If you look at standard number 159, the third paragraph here, it says, Statement of Financial Accounting Standards number 159 provides that an election can be made to value certain financial assets or financial liabilities at fair value. Included in the list of eligible items is the modification of the debt. If the fair value option is elected, then the debt is revalued at fair value and any resulting gain or loss is recognized in earnings for the period. If the fair value option is not elected, then the rules of standard number 15 apply for the debtor, and the rules of standard 114 apply to the creditor. And then the rest of the chapter is focusing on when you do not elect standard number 159, which is basically going to be the focus of our discussions here. Let's just go ahead then, and they do one other little blurb on page 386. I just want you to turn back to page 386, right above where we have the keywords, and the paragraph immediately before the keywords that I told you to check off on page 386. I just want to read this off to you, and then we're going to focus on the handout. It says, when researching impaired loan, I'm looking at page 386, the last full paragraph. When researching impaired loans, it's important that you first distinguish whether you're taking the perspective of the debtor or the creditor. Okay, the debtor is going to have the payable, the creditor is going to have the receivable. Using the word debtor or creditor in your search string may help you find the appropriate sites more quickly. Since 1977, when Standard 15 was issued, the vocabulary has changed slightly. More recent pronouncements use the terms impaired or impairment rather than troubled debt. Standard number 159 applies only if you elect the fair value option for accounting for a debt modification. All right, let's take a look at the handout on page 9. And at the top of page 9 of your financial accounting reporting handout, it says Financial Accounting Reporting Module 11, Present Value C, Debt Restructure, Standards 15 and 114, Accounting for Troubled Debt. Now, when you have accounting for troubled debt, they have two types of accounting. They have the impairments and then they have the restructurings. The impairments affect only the creditor's books. The restructurings affect both the debtor's and the creditor's books. Now, remember, the creditor has the receivable, the debtor has the payable, okay? Underneath your restructurings, you have either a settlement of the debt, which means you pay it off, or a modification of the terms. A settlement of the debt means paying off the debt by either issuing them an asset, where the debtor transfers an asset to the creditor, or the debtor gives the creditor some stock. Yeah, this really happens in the real world. I can't pay my bill, so instead, here, take some of my stock in my deadbeat company. It's just so unrealistic. Anyway, sound familiar? I think the federal government's doing that. Okay, then we have enough of the political commentary. Then we have the modifications of terms. The modifications of terms means that what they're doing is they're actually modifying and changing the debt contract. Okay? All right, now we have Statement of Financial Accounting Standards number 114, which is Accounting for Troubled Debt Impairments. This is really only affects the creditor's books. All right, this does not affect the debtor's books. It affects the creditor's books for these impairments. So let's just read the scenario and take a look at what the facts say. On December 31st of X1, the debtor company issued a $100,000 5-year non-interest-bearing note to the creditor company. Now, always remember, there's always interest associated with the note, or else everybody would go bankrupt. All right, there's always interest. When they say non-interest-bearing, usually what that means is that you sell it at a discount, and the difference between the carrying value and the face value of the debt is a discount, and that's typically called, you amortize a discount to the interest. The effective annual yield of the note was 10%. Debtor company received and the creditor company paid $62,092. That's $100,000 times 0.62092. That's the present value of $1 for 5 periods at an effective rate of 10%. So then you look at what happens on 12/31/X1, and on the left-hand side I have the creditor's journal entries, and on the right-hand side I have the debtor's entries. Now the creditor is going to debit a notes receivable, credit cash for $62,092, and credit a discount on notes receivable of $37,908. Then the debtor is going to be debiting cash for $62,092, crediting notes payable for the face amount of $100,000, and debiting a discount on notes payable $37,908. So you can see that the accounting is really complementary. Whatever happens as the carrying value of the notes receivable also becomes the carrying value of the notes payable. One is crediting cash, the other one is debiting cash. Okay, so you see there, it's very complementary, the journal entries. Then we had an amortization schedule for this 5-year note. So on December 31st of X1, remember everything is blank except for the very last column, which is the carrying value. Remember, it's the same exact amortization schedule, whether it's a payable or a note payable or a note receivable. It's the same thing. Just remember, instead of interest expense, it would be interest revenue for a note. Okay, instead of discount on notes payable, it would be discounts on notes receivable. And basically, there's no payment until the very, very end of the 5 years in 12/31/X6. And you can see how we're doing this using the effective rate, where we take the market rate or effective rate, which is 10%. Let's just do it for year X2, which is the first period. You take 10%, you multiply that by the carrying value, which is $62,092, times 10% is $6,209. You compare that with the amount of the payment, which is going to be nothing because they're not paying anything until the very end. So the plug, or the amount of discount that you amortize, is $62,009. You're going to add that to the carrying value, because what does the carrying value approach? As I have always told you, for every amortization schedule, the carrying value approaches what is owed. What is owed at the end of the 5 years when this note matures? That would be $100,000. So to get from the $62,000 up to the $100,000, they have to add that plug figure. All right, let's do one more. So they add the $62,092 plus the 6,209, which is the plug figure, that's going to give you 68,301. Let's do one more. 68,301 times 10% is 6,830. Compare that to the amount of the payment, which is 0. That means the plug amount, or the discount amortized, is 6,830. What do you do with the 6,830 of discount amortized? You add it to the carrying value, and it moves up to 75,131. Okay. Towards the end, there is a little bit of a $1 rounding error because Cindy hates pennies. Okay. Now, unfortunately, work that out, that amortization schedule. Make sure that you know how to do an amortization schedule. But unfortunately, not everything works out fine. And the debtor company experiences financial difficulties in year 20X4. At 12/31, 20X4, creditor company determines that it is probable that the debtor company will be able to repay only $60,000 of the $100,000 principal, and that the loan has now become impaired. Okay. So how do you value the amount of the impairment? What you're going to do is, at the date that the loan becomes impaired, you take a look at the carrying value of the note from the amortization schedule where everything is fine. And the amortization schedule where everything is fine at 12/31X4, the carrying value is 82,644. So you first start off with 82,644. Then you take the present value of the $60,000, which is what you think you're going to get, all right, in 2 more years. So you take that $60,000, you discount that back by multiplying it by the present value of $1 for 2 more periods at the original effective interest rate of 10%, which is the present value of $1 is 0.82645. You take the 0.82645 and you multiply that by the $60,000. That's going to give you the present value of the $60,000 being $49,587. Now you're probably saying, but wait, if that is going to be impaired. Why do we use the original effective interest rate? Shouldn't the interest rate be higher? I mean, isn't interest a function of risk? If the risk goes up, shouldn't the interest rate go up? Well, yeah, but not under the way they do the rules for impairment under Standard Number 114. They always default back to the original effective interest rate, which is the 10%. So you discount back the $60,000 for 2 periods at the original effective interest rate of 10%. If you go to the present value table, that would be 8.82645. That gives you 49,587. The amount of the impairment loss is 33,057. And then creditor, remember, this is only the journal entries that the creditor makes. Debtor makes no journal entries. As a matter of fact, creditor doesn't even tell debtor that they're doing the impairment. Because if creditor tells debtor, hey, I'm impairing your note receivable, you know what the debtor's going to do? It's going to become a self-fulfilling prophecy. They probably won't pay anything. So you don't tell them. So the creditor is going to debit bad debt expense and credit an allowance for doubtful accounts of the 33,057. And the impairment loss or bad debt expense, it's a bad debt expense or impairment loss on the note receivable. So you debit the expense and you credit the allowance for 33,057, which is the amount of the impairment. Then you do a separate amortization schedule. The separate amortization schedule, which is the bottom of page 9, is where everything now is troubled. And notice that we start off first with the 49,587, which is the present value of the impaired amount, which we think they're only going to pay the $60,000. If you take the present value of that, which is a 49,587, and then once again using the original effective interest rate of 10%, you amortize that for the next 2 periods, and you can see how the carrying value marches toward the $60,000, which is what you think that they're going to pay. All right. Now, let's take a look at the journal entries that are at the top of page 10. At the top of page 10, if you look at the bottom of page 9, they have the amount of the interest revenue to recognize. You look at the amount of the interest revenue to recognize at the bottom of page 9, where everything is troubled, and that's 49.59 and 54.54. So if you take a look at the journal entries that are not made at the top of page 10, these are the journal entries that are then going to be made by the creditor. They're going to credit interest revenue for $49.59 in year X5, credit interest revenue for $54.54 in year X6. They're going to debit the discount. Now, when they debit the discount, what that is coming from is from the amortization schedule in the middle of page 9 where everything is fine. So that plug figure for year X5 and X6, the plug figure where they have the discount amortized of 8264 and 9092, that's where they get that 8264 and 9092. So you really need two amortization schedules to do this. You need the interest revenue where everything is troubled, and you need the discount on notes receivable to amortize that. You need the amortization schedule where everything is fine, okay? Then you credit the allowance account as a plug figure, so the allowance account is plugged. Now let's take a look at the T account for the allowance for doubtful accounts. When you look at the T account on the top of page 10 for the allowance for doubtful accounts, you have 1231X4. It starts off with the 33057, which was the initial amount of the impairment. We add to it 3305 and 3638 for years X5 and X6. That gives you a balance of 40,000. Then when they default, you have 40,000 in your allowance for doubtful accounts. Now take a look underneath the T account. It says on 1231X6, the debtor pays only 60,000 of the $100,000 note at maturity. So if you look at the creditor debits cash for 60,000. They're going to debit the allowance account for 40,000, and they're going to credit note receivable for 100,000. If you take a look at the debtor's going to debit notes payable for 100,000, credit cash for 60,000, and they're going to I think there's a little typo. There should be a credit to the gain. The 40,000 is sort of like not moved over. So the credit to gain then is a 40,000. Okay. So what's happening is that we had already recognized a loss of 33,057, and then we also recognized a little bit less of interest revenue, and we had put some amounts into our allowance for doubtful accounts, okay? And so that's how the creditor boosts up their allowance for doubtful accounts, that T account, up to 40,000. And so they had a $40,000 loss, which is what happens, that's what's going on in the allowance for doubtful accounts. So the debtor is going to have a $40,000 gain. And the accounting is really complimentary. So take that 40,000, just move it over a little bit. It's just a typo, probably when they printed it off. Maybe it looks okay on yours, but not on mine. Now for standard number 15, we have accounting for troubled debt restructurings. These are settlements. So that was impairments, what we went over. And remember, the impairments are only on the creditor side. And the creditor will only, record an impairment if they think that the debt's going to be troubled, and they start amount of impairment, where they compare the carrying value from the amortization schedule, which is fine, okay, versus the carrying value what they think they're going to pay, and that difference becomes the impairment loss. With that impairment loss, they start an allowance for doubtful accounts, then they continue to amortize and put some more in the allowance for doubtful accounts until they come up with the amount that they think that they're going to default on, which was the 40,000. Now remember, this does not affect the debtor's books, and the impairment only affects the creditor's books. Now continuing on, we're going to do standard number 15. In standard number 15, this is really the accounting. It's a focus on the debtor, but I'm going to show you the journal entries for the creditor as well. When we do our accounting for troubled debt, the accounting for troubled debt can be either a modification of terms, which means you rewrite the debt contract, or you can settle the debt. When you settle the debt, you pay off the debt and the debtor gives something to the creditor in exchange for settling the debt. Now, when they settle the debt, they can do that in two ways. They can either give up an asset, or they give them stock in the company. Okay, yeah, how likely is that? But anyway, this is going to be now standard number 15. It predominantly focuses on the accounting for the debtor, but I'm going to show you the journal entries for the creditor too. This happens to be restructuring and a settlement of the debt, and the debtor is going to give creditor an asset. In this example, to settle the debt, the debtor is going to give the creditor a building. Okay, so let's just start off with our facts. In the middle of page 10, under standard number 15, accounting for troubled debt restructuring settlements. The creditor has a note receivable of $1 million and an interest receivable of $100,000. The debtor has a note payable of $1 million and an interest payable of $100,000. Remember, one has a receivable, the other one's going to have a payable. The debtor company is now going to settle the debt by transferring a building. The building has the following data. The historical cost of the building is $900,000. The accumulated depreciation on the building is $150,000, which means the carrying value or book value, which is the historical cost minus the accumulated depreciation, gives you the carrying value of $750,000. Plus the fair market value of the building is $950,000. Now, let's first take a look at the debtor's entries on the right-hand side. What's going to happen is that the debtor, it's like the debtor sells this building for $950,000 and pays off the debt. So it's as if the debtor does that. So what they're going to have to do is they're going to have to recognize a gain on the difference between the carrying value of $750,000 and the fair market value of $950,000 for this. So that's where they get the gain on the transfer of $200,000. The gain on the transfer, when they credit the gain, I'm looking at the right-hand side, which is the debtor's journal entries. The gain on the transfer is for the difference between the fair market value of the building at $950 minus the carrying value of the building at $750. We're going to credit the building at its historical cost of $900,000. We're going to debit the building's accumulated depreciation to eliminate it. We're going to debit the notes payable for $1 million. We're going to debit the interest payable for $100,000. Then, because our journal entries don't balance, we're going to either debit or credit to make them balance. In this particular case, in order to make the journal entries balance, we have to credit gain on settlement of the debt, and this is a plug for $150,000. So we plug the gain on settlement of debt for $150,000 for the debtor. Okay? Now let's take a look at the creditor. The creditor is going to record the building and its fair market value by debt. I'm looking on the left-hand side of the creditor. The creditor is going to debit the building for $950,000, and the creditor will credit interest receivable for $100,000 to remove it, and credit the note receivable for $1 million to remove it. And then what's going to happen is that you had $950,000 debit and $1,100,000 credit, so you don't balance. So what are you going to do to debit to make it balance? What you're going to do is you're going to plug it. When you plug it, that is going to be a plug to either an allowance account or a loss account. So which one do you choose, the allowance account or the loss account? The answer is it depends. If in a prior accounting period, you as a creditor recorded an impairment under standard number 114, then you would debit the allowance account because you already recorded the loss in a prior accounting period and established an allowance account. However, if you did not establish an allowance account in a prior accounting period, then you would debit the loss, okay? So you either debit the allowance account for the impairment recognized in a prior accounting period, or you debit a loss if you did not previously recognize an impairment loss. All right, so you either debit allowance or debit loss. That's a plug figure for $150,000. Now, let's take a look at the bottom of page 10. Now, let's just say that was when the debtor settles their debt with the creditor by giving the creditor an asset, which was a building. Here they don't have anything. They don't have an asset. So you know what they're going to do? This deadbeat debtor is going to give the creditor some stock. Yeah, like that would ever really happen. Well, I don't know these days. If you take a look at the bottom, the debtor company is now going to settle the debt by giving the creditor company 10,000 shares of $10 par value common stock. This has a market value of $60 per share. So they're going to give them 10,000 shares. Par value is $10 per share. Market value is $60 per share. So then let's look on the right-hand side, and let's just take a look at what the debtor does. Well, the debtor is going to debit the notes payable to remove it, debit the interest payable to remove it. They're going to credit common stock, 10,000 shares times $10 per share par value. So they're going to credit common stock at the par value, 10,000 shares times $10 per share par, $100,000. Then the additional paid-in capital is going to be 10,000 shares times the difference between the fair market value of $60 minus the par value of $10, which is $50. So 10,000 shares times $50 per share is going to be a credit to $500,000. So now you don't balance. You've debited note payable for $1 million. You've debited interest payable for $100,000. You credit common stock for $100,000. You credit additional paid-in capital for $500,000. How are you going to make $1,100,000 debit versus $600,000 credit balance? Where you're going to debit a gain on the settlement of the debt of you're going to credit a gain on the settlement of the debt for $500,000 to make it balance. And that's how you get your $1,100,000 debits to equal up to $1,100,000 credits. So you credit the gain on the settlement of the debt for the debtor. Then, under the creditor is going to credit notes receivable at the face amount, credit interest receivable at the face amount, so for $1,100,000. Then what they're going to do is they're going to debit investment in the debtor company. This is going to be for the 10,000 shares times the fair market value of $60 per share, which is $600,000. Now they don't balance. They have debits so far for investment in debtor company of $600,000 and credits to the interest receivable and note receivable for $1,100,000. How are they going to make a balance? They're going to have to debit for $500,000. They're either going to debit an allowance account or a loss account, and they're going to plug that amount. So How do you know which one to choose, whether it's the allowance for doubtful accounts or you debit a loss? The answer is it depends. If in a previous accounting period you had already recognized in a previous accounting period you already recognized an impairment loss, then you've already established an allowance account. So in which case you would debit the allowance account. If you did not recognize an impairment loss in a prior accounting period, then you would have to debit the loss for this accounting period. So that's also a plug. Notice in all of these, the journal entries are complementary. Right above it, when we settled the debt by transferring the building, the debtor had a gain on settlement of the debt of $150,000. The creditor had a loss of $150,000. Down below, when the debtor settled the debt by giving the creditor stock, the debtor had a gain on settlement of $500,000, and the creditor had a loss of $500,000. So the journal entries are very complementary until you do a modification of terms. So let's turn, so that's where debtor was just paying creditor off, and they were settling the debt by either giving an asset or stock. Now we have a modification of terms. Turn to page 11. In a modification of terms, what's happened is that the creditor is going to work things out with the debtor, and they're going to basically restructure the note so that the debtor is able to pay it. And basically what this can do, if you look at the very top, it says a modification of terms can involve, number 1, a forgiveness of principal. Number 2, a forgiveness of interest. Number 3, the lowering of the interest rate. And or, number 4, extending the maturity date of the debt. Okay, so they can forgive principal. They can forgive interest. They can say, okay, the interest rate is no longer this rate, it's a much lower rate. And then they can say, okay, you don't have to pay it off in 5 years, you have to pay it off in 10 years. So they can do one or all of these things, and it's considered to be a modification of terms. Okay? So it's the same little goofy facts here. Once again, the creditor has a note receivable of $1 million and interest receivable of $100,000. The debtor has a note payable of $1 million and interest payable of $100,000. Now let's just say, in order to modify these terms, the creditor company will now forgive $200,000 of the $1 million principal and will forgive $20,000 of the $100,000 interest. Creditor company has also lowered the interest rate and extended the due dates for both principal and interest. Okay. Assume that the present value of the $800,000 in principal and the present value of the $800,000 in principal. Now, how they get the $800,000 in principal? That's a $1 million in principal minus the $200,000 in principal that they forgave, and the $80,000 in interest. Now, how do they get the $80,000 in interest? It's the original interest receivable of $100,000 minus the $20,000 that they forgave. Okay, taking into account the original interest rate and the extended due dates, is the present value of that 800 and that 80 is now going to be 720 and 72,000 respectively. This takes into account the extended due dates, but it also takes into account that it's still the original effective interest rate. It's always the original interest rate. So what's going to happen is that the creditor is then going to credit note receivable for 280, I'm looking on the left-hand side, and credit interest receivable for 28. The way they get to 280,000 is you take the original 1 million, you forgave 200,000, so now it's 800,000. Then you take the present value of the 800,000, so it's 720,000. So it's the difference between the 1 million and the 720,000. So you credit the note receivable for 280,000. The way they get the interest receivable is they have the original amount of 100,000 for the interest receivable. Then they forgave 20,000, so now it's down to 80,000. Then you take the present value of the 80,000, and that's now 72,000. So the difference between 100,000 and 72,000 is 28,000. So you credit the note receivable for 280, you credit the interest receivable for 28, and then the debit will be a plug to make a balance. It's $308,000. Now you're either going to debit this to a loss in your allowance account. You only debit it to an allowance account if in a prior accounting period you had previously recognized an impairment loss and you established an allowance account in a prior accounting period. If you did not establish an allowance account by recognizing an impairment loss in a prior accounting period, then you're going to debit a loss. Okay, that's a plug figure. Now take a look at the debtor side. On the right-hand side, the debtor is going to debit notes payable, they're going to debit interest payable, and they're going to credit a gain on the restructuring of $220. This is the only case when you do a modification of terms where the gains and the losses are not complementary accounting. If you look on the creditor side, the loss is $308. On the debtor side, the gain is only $220. Why is the gain smaller? Because we have to take into account the time value of money, okay, because we extended the due dates for these things. Not only that, to recognize a smaller amount of gain would also be more conservative. Okay, so just keep that in mind. Then there's standard number 118. I just want you to review the disclosures for standard number 118. Okay, so just read over that. Now that we've gone over this, let's take a look at some multiple choice questions. Remember, there's no simulation that I'm assigning here. I'm just assigning multiple choice questions number 1, 2, 3, and 5. So let's take a look at those. Okay, let's first take a look at number 2 and 3. Okay, number 2 and 3. Numbers 2 and 3 say, 2 and 3 are found on page 387. And if 2 and 3 is a block of questions. Number 2 says, what amount should NOB report as a gain or loss on the restructuring of their payable? Okay, so they're the debtor, okay, because they have a payable, right? What amount should NOB report as a gain or loss on the transfer of real estate? Okay. Items 2 and 3 are based on the following. Whenever you get a question like this, make sure you understand who the parties are and whether you're dealing with the debtor who has a payable or the creditor who has a receivable. And remember that when you have an impairment will only affect the creditor's books, which is a receivable. But when you have a settlement of the debt or restructuring, which is a modification of terms, then that affects both the debtor's and the creditor's books. Okay? So items 2 and 3 are based on the following. The following information pertains to the transfer of real estate pursuant to a troubled debt restructuring by the NOB company to the Meany company in full liquidation of NOB's liability to Meany. Okay, so NOB has a payable, Meany has a receivable. The carrying amount of the liability liquidated is $150,000. The carrying amount of the real estate transferred is $100,000. The fair value of the real estate transferred is $90,000. Oh, so I can already see that NOB, who's transferring this piece of real estate, like it's a building, I guess, is going to be incurring a loss for the difference between the carrying value of the asset of $100,000 versus the fair value of the asset, which is $90,000. So item number 2 says, what amount should NOB report as a gain or loss on restructuring of the payable? Number 3 says, what amount should NOB report as a gain or loss on the transfer of the real estate? Okay. Well, what's going to happen is that NOB is going to get rid of their payable. So they're going to debit, I guess it's like a notes payable. So they're going to debit the notes payable, and they say the carrying amount of the liability liquidated will be $150,000. So the notes payable has a normal balance of credit. To remove it from your books, you're going to debit it. So you're going to debit the notes payable for $150,000. Then you're going to also remove the real estate, the asset. So I'm going to credit the asset. I'm going to credit the asset at its carrying value. Typically, we would credit the historical cost and debit the accumulated depreciation. We don't know the historical cost. We don't know the accumulated depreciation. But since the historical cost minus the accumulated depreciation is the carrying value, we're just going to credit off the carrying value. So the carrying amount of the real estate transferred is $100,000. So I'm going to credit the asset at $100,000. Ordinarily, as I said, I would credit the historical cost and debit the corresponding accumulated depreciation. I just don't know those things, so I'm going to have to credit the net amount. Then I'm going to have to recognize a loss. This is a loss which would be sort of like a disposal of this asset, okay? So that loss will be for the difference between the carrying value of $100,000 versus the fair market value of $90,000. So that's a loss of $10,000 there. And now I don't balance. So I have total debits of $160,000, and then I have a credit to the asset of $100,000. What am I going to do to make this balance? 160, 100, so I'm going to have to credit here for 60, and because it's a credit, this is going to be a gain, and that's a plug. Remember, if it's a debit to make it balance, it's a loss. If it's a credit to make it balance, it's a gain. And this would be a gain on the settlement of the debt, not a restructuring, it's a settlement. So let's answer the questions here. Number 2 says, what amount should NOB report as the gain or loss on restructuring of the payable? Well, the gain on restructuring of the payable would be $60,000. So the correct answer for number 2 would be D, like David. Number 3 says, what amount should NOB report as a gain or loss on transfer or disposal of the real estate? That would be a loss, because it's a negative amount, for $10,000. So the correct answer for number 3 would be A. Remember, you can choose A, but only if you're sure. Please be careful. These are two completely different things. This is like a gain or loss on disposal. In this case, it was a loss for the difference between the carrying value of the asset of $100,000 versus its fair market value of $90,000. This is a plug figure here, which is a gain on the restructuring of the debt. Okay? So the answers then for 2 were D, like David, and 3 was A. Okay, let's take a look at a modification of terms one. That would be multiple choice number 5. Number 5 is also found on page 387. Number 5 says, assume that Colt does not elect the fair value option for reporting the debt modification. How much should Colt report as a gain in its income statement for the year ended December 31st, 2008? Okay. The Colt Company is indebted to the Kent Company under an $800,000. So Colt is the debtor and Kent is the creditor. Under an $800,000 10% 4-year note dated December 31st, 2005. Annual interest of $80,000 was paid on December 31st, 2006 and 2007. During 2008, Colt experienced financial difficulties and is likely to default unless concessions are made. Not unlike what's going on in the mortgage industry right now. On December 31st of 2008, Kent agreed to restructure the debt as follows. The interest of $80,000 for 2008, which was due on December 31st, 2008, was now made payable on December 31st of 2009. So they're going to say, we're going to delay you paying the interest for 2008. You don't have to pay it until 2009. Interest for 2009 is waived, so that they're like no interest in 2009. And then the principal amount was reduced from the $800,000 to the $700,000. So they forgave some interest. They forgave some principal of $100,000. So assume Colt does not elect the fair value option for reporting the debt modification. How much should Colt report as gain on its income statement for the year ended December 31st, 2008? This is not unlike what was going on in our handout at the top of page 11. But remember, you are doing the journal entries for Colt, who is the debtor. And remember, the debtor is not going to take into account the time value of money because that would just make their gain larger. The one who takes into account the time value of money on these restructurings is going to be the creditor, but they don't want the creditor. What they want is they want the debtor. Plus, they don't give you any present value figures here. So what's going to happen is that you're going to compare the total future cash flows with the carrying value of the debt. So let's just see what's going on with this. Okay. All right. The total future cash flows. And then we're going to have the carrying value of the debt. The carrying value of the debt consists of the $800,000 in principal, and then we have 2008 interest of $80,000. Okay. Now, and then they say 2009 interest they're just not going to have to pay. Okay. So then that's a total of $880,000. Then the total future cash flows is now, instead of $800,000 principal, it's going to be $700,000 principal. Okay, and the $80,000 won't be due until 12/31 of 2009. Okay, so they allay it, and they say 2009 interest we're going to be waiving. So that's $780,000. So what's the comparison? The difference between here and here is they forgave $100,000. Okay. So let's see, because the difference between 780 and 880, which was the difference between the carrying value of the old debt versus the future cash flows of 780. And remember, you do not consider the time value of money. If you consider the time value of money, then what would happen is when you take the present value, remember present value is a less than concept, and this amount would go down. If this amount goes down, then that would just make the amount of their gain larger, and that would not be conservative. Okay, let's answer the question. Assume Colt does not elect the fair value option for reporting the debt modification. How much should Colt report as gain in its income statement for the year ended December 31st, 2008? The correct answer is $100,000. So the answer there would be B, like Barbara. Okay, we're going to do one more and then we'll be done with this. Multiple choice number 1. Number 1 says, for a troubled debt restructuring involving only a modification of terms. Oh, did we just do that? Just a modification of terms? Which of the following items specified by the new terms would be compared to the carrying amount of the debt to determine if the debtor should report a gain on the restructuring? Okay, and this is a theory question. So let's start with letter D. So what would you compare to the carrying value of the debt, the carrying amount of debt, which we just showed right here? Okay, would you, letter D, compare the amount of future cash payments designated as principal repayments? Well, no, it's not just the principal. It's also going to be what? The interest, okay? So it's not answer D. How about answer C? The present value of the debt at a modified interest rate. No, we did not calculate the present values, because if you took the present value of this, it would be less than 780. And then when you compare that to the 880, then that would make the gain larger. You do not take the present value for the debtor in a modification of terms. You only take present value on the part of the creditor. So it's not answer C, okay? How about letter B? The present value of the debt at the original interest rate. The present value of debt at the original interest rate. Now, we don't take into account present values. How about letter A? The total future cash payments. Yeah, that's the answer, the total future cash payments. So, once again, I'm dropping pens again, for a troubled debt restructuring involving only a modification of terms, which of the following items specified by the new terms would be compared to the carrying amount of the debt? To determine if the debtor should report a gain on the restructuring, you just have to compare the total future cash payments versus the carrying value of the debt. So the correct answer there would be A. You can choose A, but only if you're sure. Okay, and especially when you have these theory questions, make sure you start off with the last answer, letter D, and then work your way up to make sure that if you choose A, you've already looked at all the other choices. So the correct answer for number 1 is A. All right, then, I'll be seeing you. I won't see you in Module 12. I'll see you then in Module 13 when we talk about earnings per share.